Thank you for taking the time to tune into this podcast. My name is Ayanda Zondi and I'm a Senior Client Investment Specialist. I'll be taking you through this presentation. This podcast focuses on the pure fixed interest local portfolio. The pure fixed interest local portfolio is a low to moderate risk fixed income portfolio solution that's designed to maximize the likelihood of meeting its investment objective, which is to achieve steady growth of both income and capital. This is achieved by mandating specialist asset managers that as a whole provide for a portfolio that enjoys a variety of investment styles, which strengthens overall diversification. We believe that this approach offers a compelling value add to our portfolio construction in order for this portfolio to achieve its objectives and deliver risk-adjusted returns over the long term. The portfolio is managed by three highly rated managers with different investment styles. We use different investment styles to improve consistency of performance over time under varying market conditions. The core style is important for anchoring the portfolio to the benchmark. Managers that follow this style are not given too much flexibility in terms of the types of instruments that they can hold, and limits are placed on their duration positioning. The Core Plus style is important for similar reasons, but slightly more flexibility is given to the asset managers in terms of the instruments that they can invest in and their duration positioning. There's also a particular focus on the credit capability as one of the main sources of alpha. And lastly, the unconstrained style, which primarily is used for yield enhancement through the relaxation of restrictions in terms of what a manager can invest in and wider flexibility in terms of duration positioning. Coronation acts as our core manager and plays an integral role in anchoring the portfolio. Future Growth is our Core Plus manager, and they also have a very strong credit capability. Precinct is our unconstrained manager with no duration limits. Managing our portfolios with a strong focus on risk means that we seek to allocate assets in a way that provides exposure to different investment styles. This ensures better diversification and reduces the probability of one investment style dominating the fortunes of our portfolio. The portfolio delivered a return of 15% over the year and is well ahead of its benchmark over all longer-term measurement periods. The long end of the term structure of interest rates continued to be the key contributor to the returns of the All Bond Index in the first quarter of 2022. The relatively steep yield curve, material improvements in our fiscal metrics as a result of higher commodity prices, as well as the low to negative real yields in many developed market government bonds, sparked renewed interest by foreign investors into our domestic market. The portfolio also delivered strong returns during the quarter, outpacing the ORBI. The portfolio's outperformance can be attributed primarily to favorable positioning on the yield curve. The portfolio was overweight the long duration bucket by 8% over the quarter. This active bet added value as the curve reshaped and the slope flattened, resulting in long-term yields rising less than short-term yields. The portfolio was also marginally long duration by 0.3 years compared to the ORBI, which added value as yields generally dropped. All three of our managers were ahead of the benchmark over the quarter. Precinct was the best performing manager as they continued to benefit from their significant overweight positioning to the long end of the curve. They also benefited from taking on higher interest rate risk when compared to the ORBI, which contributed to performance during the quarter. The manager's performance is in line with our expectations given the current market environment. Future Growth also contributed strongly to performance during the quarter. This manager had superior selection of better performing bonds within the different maturity buckets. In addition, they also benefited from their exposure to corporate bonds, which added value as spreads tightened somewhat. Coronation also had a firm quarter driven by their yield curve positioning and duration bets. The manager was overweight the long end and the belly of the curve while taking an underweight stance to the short duration bucket, thereby benefiting as the curve reshaped. When constructing the portfolio, the intention was to ensure that exposures were made across a wide range of interest-bearing securities, and we wanted to mitigate the probability of capital loss. The portfolio is primarily invested in a spread of nominal bonds, which are supplemented with allocations to inflation-linked bonds, short-term paper, and cash-like instruments, but bonds maintain a large portion of the allocation within the portfolio. The portfolio is invested in bonds that are issued by the government, as well as corporate entities, state-owned enterprises, and banks, all of which provide an investor with an investment return better than cash. The allocation to the inflation-linked bonds is intended to protect the portfolio from the value-eroding effect of inflation. Thank you for taking the time to listen to this podcast. We hope you found it informative. Please visit our website to access our latest insights, content, and media publications, or you can contact your consultant for more information. And thank you for your ongoing trust in Alexforbes.